You know, it's interesting. I will start with you with Japan, of course, but we will talk a little bit more about the region. Between the structural changes in the macro environment, let's dive into what's creating the opportunity here, starting with the macro. People say that the changes in the interest rate regime might be one big reason we're seeing a potential sea change. How much will it matter?
In Japan, it's going to matter a lot. And thank you for having me here. In Japan, it's going to matter quite a bit. I mean, the macro factors that Japanese companies are faced with right now, rising inflation, rising rates, less labor, and therefore wages are going up. They haven't seen a change in cost structure in 3 decades. So, you know, the Japanese government was actually quite thoughtful in saying, how do we arm an economy that's been financed with zero rates, which has financed stagnation for the last 30 years. It's financed losses, it's financed excess labor, it's financed excess assets. How do we give the tools to these Japanese companies to respond to these macro challenges? And there's been a number of changes. METI has come out with a number of changes. The Tokyo Stock Exchange has come out with a number of changes. And so you're seeing this wave of this big catalyst that is creating a wave of transaction activity, both for activists, for spin-offs, for buyout shops, for private capital providers. And so that's why there's a lot of excitement with Japan right now and how they're going to face these macro headwinds.
Let's talk more about the structural changes in a moment here, those shareholder-friendly rules, but more on the macro for a moment, because the higher interest rate regime, there's a question of what it's meant for the Japanese funding currency to have fueled so much investment across the world, particularly in the United States, with Japanese institutions being such large buyers of US assets, US treasuries in particular. A large global investor recently told me that there could be a sucking sound that's underneath the market out of US assets. Do you believe that?
It's hard to have a really solid view. I mean, there's a couple different dimensions on how to answer this. If you look at just the pure carry trade, nobody knows how much of the carry trade is unwound, but if you just look at the carry that you're getting versus the volatility, it actually doesn't make sense to put on a carry trade for at least US assets. Then if you look at Japanese companies actually investing in hard assets versus Japan, you know, the Bank of Japan a couple of years ago indicated to insurance companies, to banks, to companies, don't use cheap yen to go finance your assets in the US. We need it to be currency matched. Because if you sell the yen to go invest in the US, we, the BOJ, we're just buying it back in the market. So go raise local currency to fund the local assets. And the final thing is, you know, where would you see that sucking sound come from? It's not coming from the life insurance companies. The life insurance companies, as rates started going up a couple years ago, they were short duration on the assets. They rotated to match their duration. This is at a good time because the new solvency standards have just come into place. So I don't think you'll see it from the insurance companies. So there's this weird dynamic between retail, who right now is investing through these NISA accounts, selling the yen, buying US dollar assets still, but pension plans effectively rotating out of fixed income and coming back, global fixed income and coming back to Japan.
It's interesting. I was going to ask you about institutional investors and what it means, but maybe I should ask just as much about retail.
In terms of the difference between the yen and the dollar and what the...
What changes in terms of the way a Japanese investor wants to invest? You are presumably in talks with many types of them on a regular basis, let alone investors across Asia. The advantage you have here is that you could put them in assets in the US, you could put them in assets in Europe. So what exactly is it that investors want to change about their attitude in where they invest?
Yeah, so this is a bit of a unique perspective that you get being in this region versus maybe sitting in the US is, if you walked around the region in December, right after you knew the election, but you didn't really know what policy was going to be, everybody would have told you that they were over-indexed to US assets. I mean, that was before they knew anything about tariffs, before they knew anything about what spending plans would be. I don't think many investors expected a push factor out of US assets. They expected a pull factor. The only pull factors that are large enough would be Europe, China, or commodities. And so I think that what the tariffs have done is they've pushed investors to consider that more and faster and look at different ways to put money into those big geographies. But so that's from an investor perspective, they're thinking about, how do I get diversification? Because I'm over-indexed to the US. How do I get diversification? We've been talking a lot about with you. One source of diversification is public-private. The big one out here is also currency now. And so a lot of investors are thinking about, where do I put my next dollar from a currency perspective?
And what's the answer?
there's a lot of different perspectives. I think that there's a difference in portfolio construction and hard asset construction. Hard asset construction, you see a lot of the Japanese looking at places where there's growth and where there's labor, because those are the two things they don't have. And so Southeast Asia is a big one, India is a big one. From a portfolio construction perspective, all of the second-tier markets from a size perspective, Japan, Australia, India, have absorbed almost all the capital that they possibly can. So there's been a lot of interest in Europe. We've made a big push in Europe for private credit. And at some point, I'm sure that these investors who have been in and out of China will turn their sights back on China.
What is it about the structural changes? We kind of alluded to them earlier, the shareholder-friendly reforms that are happening in Japan. On the face of it, you can look at a US hedge fund and you can see why they might want to capture that. From a private markets perspective, why does it matter to you?
Well, it's interesting. Before I came out to Asia 3.5 years ago, there was this accepted wisdom at the time that things in the capital markets will be created in the US and then Asia will adopt them a couple years later. And you're seeing that in private capital. I mean, you looked at the big SoftBank loan that we did. You looked at how we helped Sony finance an asset in the US. There's lots of headlines about how we are helping others finance assets in the US, Japanese companies in the US. Japanese companies are starting to really understand the utility of private capital. For 30 years, again, they just went to their banks. It was cheap. If money is free, you don't really ask what they're giving you. You just take the money. Now that money is not free, and the cost of capital is going up, and your cost structure is going up, and investors are asking you to think about how do you optimize your capital structure. Now all of a sudden, okay, you go to your bank for stuff that's really cheap. You go to the bond markets if you need the bond markets, but for anything that you need customized or tailored or longer duration, you look at private capital.
It's interesting. I want to point out the poll results too, because very fascinating. It's not necessarily rising borrower demand. About a fourth of the audience said that that was the reason that private capital was seeing a lot of interest. By the way, in the US, I would bet that that was a higher number in the United States. Differentiated returns, that's the clear leader here. What do you make of that?
Well, I come from a contrarian firm, so I'm going to actually have to disagree. Look, I think that the biggest positive of what's going on from a trend perspective, and this has actually nothing to do with Trump, this is what was going to happen. You've seen increased regionalization. And with increased regionalization, you're going to get business models that don't rely on the volatility that can get created by changes in trade policies. That makes Asia more investable. It means that geographic diversification will actually play out for the first time in many, many years in a portfolio. But I think that the way that the fund structures are set up today and the strategies are set up today, it's really hard to get credit, excess return per unit of risk in credit and scale across Asia, because everything is niche, or everything is just targeted to one strategy, and deployment happens in that strategy irrespective of global pricing trends. So I actually find it mostly on the borrower demand. At least that's what we see in our business. I was mentioning on TV earlier that both in Japan and in Australia, the government and companies are asking, how do we fund a 10-year project? How do we fund a 15-year project? How do we fund a 30-year project? And you compare that to like the Japanese bank balance sheets. Japanese bank balance sheets, on average, their loans are 3-year duration. And on average, they're lending at 175 basis points over. So short duration, high quality. And so how do you get something that's longer duration, or how do you fund a story that needs some diligence? It's going to be private capital. So I think that what you're going to see is you're going to see growth in demand for capital from borrowers, and banks aren't going to necessarily be able to step up with their balance sheet, but they're still going to intermediate most of it out here.
You know, it's really interesting because for those who don't know, you were a very big part of Apollo's story in the push into insurance. Japanese insurance companies, the move that you've been making there in insurance and reinsurance. Explain what's happened so far and explain where Apollo's going with this to the point you were making that people are looking for different structures for investment right now.
Yeah, so the insurance industry is really interesting in Japan right now. One is, we know Japan is a savings market, but it's a savings market in large part because there's been deflation. And so the rational thing to do is to put your money in deposits or put your money into a guaranteed yield that gets you something better than zero. So annuities worked really well, and protection, life protection worked really well. And we showed through our reinsurance business that we were able to help offer policyholders better yield by taking yen liabilities, investing them in U.S. assets, and then translating it back to U.S. dollars. And we built a very nice, and we have a very nice business in Japan on the reinsurance side. But what you're going to see is you're going to see with the new capital standards, you're going to see much more of a blend of savings product and investment wrapped product, which actually comes at a very good time because if you look at the $7 trillion of consumer deposits in the banks, a big chunk of that is with people who are in the final chapters of their life. And when they die, that money goes to their heirs. Their heirs are going to want to invest in investment product. And so, Japan's going to be an interesting market both from the lens of savings as well as what you get, for instance, in Hong Kong with is like a participating product, which is much more of an investment-linked product. So we have, one, the ability to guarantee the yield through our retirement services business if it's a savings product. And if it's an investment product, we have a whole suite of what we call stay-rich products, not get-rich products, to help savers invest better.
So what does this mean in terms of future product launches? I have very much watched Apollo be at the forefront of the retailization of private funds. I have I guess a joke with one of your colleagues that one day you could see Apollo on your iPhone, right? So what does that mean in terms of the types of products you can offer to Japanese investors, given it seems like there's a fairly competitive thing going on? It almost seems easier to launch a retail product in Japan than in the United States.
So there's going to be a suite of products, just like you have, I'm sure you've talked to my colleague in the US. You have products for high net worth and ultra high net worth, which are really risk-taking products. Private equity, a private equity fund, which is drawdown, locked up money, and you're looking for 20% plus returns. But those individuals have diversified portfolios, and they're well advised, and they're financially sophisticated. You go all the way to the other end for the average investor. The average investor is going to want something that's more liquid or something that's safer or guaranteed. And so we basically can offer anything in between, so long as it adheres to our three principles of excess return per unit of risk, we're focused on downside protection, and that we ourselves, importantly, we ourselves want to buy it alongside those consumers.
It's interesting because liquidity has been a huge topic in private markets. Sometimes it works, sometimes it looks a little risky. How far can you go?
Well, you saw liquidity not work in the public markets a couple times now as well. In the US, you've certainly talked about this with some of my colleagues. There is a convergence in liquidity, at least in the investment grade part of the spectrum, because it's going to be a massive market, $30–40 trillion, and it's mostly ratings driven. And it sits in the parts of investors' portfolios that need turned over for all sorts of reasons. It could be liquidity, duration management, matching adjustment management, sector and risk management. So you will see increased liquidity there. It's harder to see Asia assets, private assets, achieving the same liquidity anytime soon.
Really? It's interesting you say that because another thing that we've been talking to investors a lot about is this idea of tokenization. That's another thing Apollo is focusing a lot on. Investors in Hong Kong in particular seem to be clamoring for tokenized funds tied to private assets. Can you do it? Can you do it quickly? Are there concerns?
There's a lot of discussion about that. You're absolutely right. It's a big trend both in Hong Kong and in Singapore. The big, large private banks are talking about how to do this. Primarily, they want to be able to provide a better service to their underlying customer. They want to reduce costs, and they want to fractionalize interests. And you would hope that with fractionalized interests, you should be able to provide a little bit better liquidity than the underlying liquidity of the asset.
So it's a go.
It's an experiment so far.
We will keep an eye on that. When you think about the amount of dollars that are coming into Apollo these days, where's most of it coming from the region? So we have a very large private high net worth business that's coming mostly from Hong Kong, Singapore, and we recently made a big hire in Japan. We'll be massively expanding that team over the next year. It's still coming from the big sovereign wealth funds. And it's really coming from the insurance companies now, too. The insurance companies are probably 4 or 5 years behind where the US companies are in embracing private investment-grade assets, in part because private investment-grade assets really exist in scale for investors in the US. And so a lot of the insurance companies are now looking to benefit from that excess return per unit of risk that you can get from investment-grade private credit. So then what is the next frontier? To the extent that you have that paper that you're trying to fill out at Apollo on what your biggest growth area is for the next 2 to 3 years, what is it?
Look, certainly high net worth and accessing retail consumers is one of the biggest opportunity sets out here. And that's both in high net worth and that's partnering with traditional asset managers to blend some privates and publics in the same wrapper. The Australian superannuation system will be a massive opportunity for us. That system will be the second largest pension system in the world by 2030. It's all been designed for accumulation. They're going to need to start thinking about decumulation. Our retirement services business and safe yield offerings fit in nicely there. And then accessing the Japanese saver, that $7.4 trillion of deposits, the $2 trillion insurance industry, the $2 trillion of household investments. It is ripe for what we provide, and we have to figure out how to more effectively engage with the consumer, but those are the big three opportunities.
It seems to be a big megatrend. I promised you at least one curveball. Do you think that the US can replicate the annuation system that is in Australia to any degree? That seems to be the holy grail.
We have a version of it with the 401k system. But I don't think that the U.S. will be able to, at this point, replicate what the Australians have done with the superannuation system. It was 30 years in the making of what they've been able to do.